Hey guys, it's Nick, and in this video, I want to talk about if the Fed just called the top of the stock market and we're heading for a crash. In the last few days, we see that in the yearly disclosure of Robert Kaplan, who is the president of the Dallas Federal Reserve Bank, it shows that he's been trading all kinds of stocks in and out all during 2020 to the tune of a few $100 million. Now, it took all of this news to come out and people posting this and shaming him for him to all of a sudden get ethical and decide that he's going to dump all of these stocks before September 30th, coincidentally, right about the time when the Fed is talking about starting their tapering. So since his trading all during 2020 was based on advanced information of what the Fed is going to do, now that he's going to sell everything before September 30th, is this also advanced information knowing about what the Fed is going to do now that they're talking about tapering? Did he just signal that this is going to be the top of the market and he's getting out of his stocks? So I'm going to look at his stock trades and estimate how much money he had to have invested to do these trades to get the dividends that he got. And I'm going to look at another case where this happened back during the financial crisis with a colleague of his in 2006. And we're going to take a look at that and see the similarities. So the more things change, the more they stay the same. So stay tuned and check this out. So here's a story on Zero Hedge. Following mass outrage, Fed Presidents Kaplan and Rosengren will sell all their stocks due to ethics concerns. So they didn't have any concerns while they were doing all this trading, knowing that the Fed was going to bail out everybody out of the market. But now they've been shamed and talked about. Now they found ethics concerns. It's a little bit like how the episode of Seinfeld where George Costanza had sex on the desk in his office and the boss found out about it and he claimed ignorance, saying if he knew that that kind of thing was frowned upon in the office, he wouldn't have done it. So this is kind of the same thing. Like, oh, you mean it's not ethical to trade hundreds of millions of dollars with inside information of what the Fed is going to do, especially since I'm one of the people that is voting on what the Fed is going to do in terms of bailing out the economy. So here, Zero Hedge makes fun of Kaplan on Twitter. This is Kaplan saying data now suggests September taper announcement, October start. And coincidentally, he's going to dump everything September 30th. And now here he is on the phone saying, dump it all. So here's a look at the stock market that they've been buying ahead of knowing that the Fed is going to bail everybody out, and they are the ones who are actually voting on that. So they've been buying stocks all the way up, but now are selling due to ethics concerns, Kaplan and Rosengren. And here's the part you need to pay attention to. The presidents of the Federal Reserve Banks of Boston and Dallas said Thursday they would sell their individual stock holdings by September 30th amid ethics concerns and invest the proceeds in diversified index funds or hold them in cash. Why would you hold them in cash unless you knew what was coming up? And here's a really obvious but pertinent question. Why did it take a public shaming on Twitter to inflict some common sense into these multimillionaires? And how is it that Powell, Yellen, and Bernanke had no problems with any of this? And if they thought that day trading on this inside information was perfectly normal, just what other unethical activities has the Fed been engaging in? Now, here's the first page of Robert Kaplan's reporting, and here it shows that all of these stocks, Apple, Alibaba, Amazon, Boeing, Chevron, they are all checked off in the over $1 million value of assets category. So you can't really know, is it $1,001 or is it $100 million? However, they also have to report the dividends that they got from these stocks. So here, Apple, Boeing, Chevron, Enterprise Products, and all these other companies, they show how much dividends they received. And there's different categories, anywhere from none 200 to 1,000, 1,000 to 25,000, 25,000 to 150, 150 to 500, and over $500,000 in dividends. By looking at how much dividends he received, you can figure out approximately the minimum of how much money he would have had to invest in each of these stocks to get these dividends. So this category, 150 to 500,000, I assume the minimum amount, 150,000 in dividends. And this one over 500,000, I assume he has only $500,000 in dividends. It could be $10 million in dividends, who knows? But I'm just assuming the lowest amount. And then I figure out how much money he would have had to put into these stocks based on the dividends they received in 2020 and the average price of that stock in 2020. So here's what I put together. These are the stocks that were in those categories of total dividends, 500,000 or 150,000 to 500,000. So here they all are. These are the total dividends that each of these stocks paid out during the year. And this is approximately the average price of where they traded during 2020. And so these are the total dividends he got on the low side, being conservative. And these are the number of shares he would have needed. So in other words, Apple paid out 81 cents a share in 2020. To get $500,000 in dividends, you would need 617,000 shares at an average price of $70. That would cost you about $43 million in Apple stock to get that $500,000 dividend. So I did that for all the rest of these, and I came out with a total of about 286 million on the low side. Now, that doesn't include all the other stocks where he had positions over $1 million, Google and all these other ones that he had bought and sold, and it said multiple times. So he could have been day trading those things all day, who knows? And coincidentally, Robert Kaplan was a former Goldman vice chair of investment banking, and he left Goldman Sachs in 2006. Now, if you don't know, the CEO, Hank Paulson, also left Goldman Sachs in 2006 to become Treasury Secretary. Now, Paulson wasn't day trading stocks like maybe Kaplan or some of these guys were, but he got a real sweetheart deal to get rid of all his Goldman Sachs stock without paying any taxes to become the Secretary of Treasury. And he is known for the $700 billion bazooka that he demanded from Congress with no oversight to bail out AIG and, in effect, Goldman Sachs during the financial crisis. So here's this article in 2006. Henry Paulson filed to sell $500 million worth of Goldman Sachs stock after U.S. Senate voted to confirm his appointment. At a price of about $152, the stock is worth $492 million. And it says he is unloading the shares to adhere to conflict of interest rules. I guess they don't have any of those at the Federal Reserve banks, huh? Now, in addition to the 3.2 million shares, he also had restricted stock units, 494,000, and options to purchase 680,000 shares of common stock, all which are exercisable. So all that together is about 1% of the outstanding shares of common stock of Goldman Sachs. So interestingly, under U.S. government ethics rules, Paulson is required to sell the shares. He is also exempt from paying taxes on any capital gains of the sale if he obtains a certificate of divestiture. So The Economist estimated the rule eliminated a tax liability of up to about $200 million for Paulson. So either you're getting a tax exemption of $200 million, or you know what the Fed's going to do ahead of time and you're buying and selling stocks basically risk-free and making a few $100 million in the process. And now here's a chart of Goldman Sachs going back to 2006 before the financial crisis. This is where he sold his stock around here, $152, something like that. It went up in the next year up to like, what, 240, 250, but after the financial crisis, it fell to almost $40. Now, even if he wanted to, he couldn't sell all that stock because as an insider, there are restrictions on when you can sell the stock and how much you can sell based on the volume of the last 30 days, and there's only windows you can do it, before and after earnings and all kinds of stuff. So there was no way he would have been able to dump all that stock before the financial crisis hit. And I'm sure he had an inkling of it because his firm was at the head of doing all of these CDOs that blew up AIG and all these other companies. Now, being the CEO of Goldman Sachs, you would think he had a handle on the economy and knew more than everybody and that kind of thing. Let's see some of the statements he made. In April 2007, he said the housing market was nearing a turnaround. All the signs I look at show the housing market is at or near the bottom. The U.S. economy is very healthy and robust, Paulson said. In August 2007, Secretary Paulson explained that the U.S. subprime mortgage fallout remained largely contained due to the strongest global economy in decades. So even though he sold his stock, there were still questions remain about Paulson's interest, despite having no direct financial interest in Goldman, since he had sold his entire stake. The Goldman Sachs benefit from the AIG bailout was recently estimated at $12.9 billion, and Goldman Sachs was the largest recipient of the public funds from AIG. And creating the collateralized debt obligations, or CDOs, forming the basis of the current crisis, was an active part of Goldman Sachs' business during Paulson's tenure as CEO. So Hank Paulson was the CEO of Goldman Sachs, who created this mess and got to sell his stock tax-free, and then talked up the economy as things were getting worse. And then when things got really bad, he came out and said, give me $700 billion and give me no oversight. I want to decide who to give this money to without anybody asking any questions. Now, when he originally came out with that 3-page ransom demand of $700 billion and don't ask me how I spend it, otherwise the financial world will blow up, he later backtracked that after getting a lot of pushback and said that, I thought it would have been presumptuous for us on that outline to come up with an oversight mechanism. But that's not what it said in Section 8 of his plan. And it said, decisions by the Secretary pursuant to the authority of this act are non-reviewable and committed to agency discretion and may not be reviewed by any court of law or any administrative agency. So I'm unelected and I get to decide what to do with taxpayer money, and nobody could ask me any questions, even if I give it all to bail out Goldman Sachs or all my buddies on Wall Street. So guys, that's how it really is on Wall Street and with the government. They get all kinds of deals and don't have to play by the same rules that you do. And when their actions come to light and they get shamed or whatever, they say, oh, it was an oversight. Oh, because of ethics, I'm going to do this or that or whatever. But they always make out in the end and we lose. So keep that in mind. So did Robert Kaplan all of a sudden become really ethical, or it's just because of all of this news of his filings and his trading is out there and a lot of people are angry about it? Or could it be that he knows that the taper is going to happen and he's using this as an excuse to get his money out and to go all into cash before the stock market falls? So whether he's getting out of stocks because of the publicity or because he knows that the stock market is going to fall, I don't know which one is true. But what it does show you is that there is a lot of shady stuff going on in Wall Street and the government and the Fed, and they are obviously not on your side. They are on their own side. So keep that in mind the next time you're day trading Apple or Tesla or something. The person on the other side of your trade might be Robert Kaplan or some other Fed president that's killing time during a Federal Reserve meeting. If you like this video, hit the thumbs up, and I'll see you in the next one. Thanks for watching, guys.